When it comes to investing, many people are looking for low-risk options that can provide a steady return on their investment. And there are three popular options for such investors like fixed deposits, Singapore savings bonds, and T-bills. So each of these investment options has its own advantages and disadvantages, and it can be difficult to determine which one is the best fit for your personal finance goals. So let's compare these three instruments, the good, the bad, the ugly, and at the end of the video, you will know which one of these three is the best for you. So the first contender that we have is fixed deposits. So fixed deposits is a deposit account that allows us, bank users, to deposit money into an account that pays us a relatively higher than normal interest. But the drawback here is that your money will be in this account for a stated period of time, which means less liquidity. And if you choose to withdraw this amount of money earlier or before that period of time ends, then you will incur a loss of interest. So the good thing about fixed deposits is how easy it is to get started with them, because there is no barrier of entry other than just having the bank account itself. And across the board, almost every bank in Singapore has a fixed deposit scheme that is paying between 3.2% to 3.9% depending on the bank and the amount that you pledge into the account. So if you ask me, I think FD or fixed deposit is great because the interest is slightly higher than the latest release of T-bills, which is at 3.65%. The other benefit of fixed deposit is the shorter tenure period that's available right now. So banks like ICBC offers as low as 3 months tenure for a 3.75%, which is almost the best rate you can get in the market right now because the minimum deposit is only $500, which is super low. And with a shorter tenure period, the earlier you can get your money out, which then can be put into another fixed deposit period, allowing you to compound your interest over time. So I do have a fixed deposit account with ICBC and it's locked in for 1 year, but it's on a monthly renewal basis. So what I went ahead to do is to set a running instruction to withdraw my interest plus principal and it be renewed for the following month, and this allows me to compound my interest. So the best benefit that I like about fixed deposit is the insurance or SDIC, and this covers my money up to $75,000 in the event the bank topples or becomes like a Silicon Valley bank where the bank run happens.
Sanjay, it's time for another bank run.
So fixed deposit do sound great, but these high interest rates are only available during high interest environments like this current environment. And this can change anytime with the bank's discretion. And looking at the chart from Sidley, if you do want to enjoy a higher rate of interest like 3.9%, you'll need a larger sum of money as well. So now let's look at SSB or Singapore Savings Bond. So Singapore Savings Bond has been a trend for the last 6 months because of the high interest rate it was giving. But in recent times, the interest has dropped and is dropping very badly right now, which isn't too good for us. So Singapore Savings Bond is a government bond by the Singapore government, and it's considered one of the safest long-term investments because SSB has a tenure of 10 years, which means that if you apply for the bond at today's date, let's say you should apply it for today and you get 3.5%, this will be the average interest that you'll be getting over the next 10 years, which is pretty decent. So for SSB, the investment amount is also very low at $500 to get your first lot. So the interest for SSB is paid out biannually, so every 6 months you get some money back into your bank account. So for example, let's say you get April 2023's SSB. So your next payment interest will be in October 2023. And with an investment of roughly $1,000, you get $15 in October and $15 in April 2024, so on and so forth. So every year you get roughly $30 of interest. So Singapore Savings Bond do come with its downside as well. So since the interest rate is sort of floating, those that got SSB maybe a year back might not have very good interest rates. So if you do have SSB, do check out the interest rates that you are on and see if it's a wiser choice to redeem those bonds then and apply for a new one which might give you higher interest. So lastly, we have T-bills. So T-bills or treasury bills are short-term tradable government debt securities that we can invest and buy at a discount.
Crushing debt.
So T-bills works a little bit different from fixed deposit and SSB. So with fixed deposits and SSB, your interest is paid at the end of the tenure or at a certain time frame. But with T-bills, your interest or your discount is paid upfront. So you receive your interest now, and after the tenure of 6 months, you'll receive your capital back. So a quick note, T-bills do have a minimum of $1,000 investment, so this is something for you to consider if you're looking into T-bills. So in the previous T-bills, the discount or interest was at 3.85%. So this means that with $1,000 allocation, you only need to pay $1,000 minus $3.25, which gives you $980.75. So to get this number, you need to take $1,000 times the interest rate, which is 3.85%, and divided by 2 because the interest for 1 year, but the tenure is only 6 months. So after 6 months, when the bill matures, you will receive back your $1,000 into your bank account. So now that we have covered all 3 different instruments that are very same or very similar in some way or the other, you might be thinking which one you should use. So it's easy to say to go with the one with the highest interest, but these do come with caveats like ensuring that you don't need that sum of money for that period of time. For example, like in T-bills, you need to lock it in for 6 months, which you have no access to. So right now, there is 2 main strategies that we can use, but these 2 strategies are based on the current environment, and things will be very different depending on when you watch this video, and this is why you have to subscribe to the channel. So if you're fresh out of school and in your new job, this might mean you might not have much savings and you're still focused on building your career. So if you fall into this category, then leveraging on fixed deposits will give you the best chance of growing your money. So ICBC's fixed deposit only requires $500 as a minimum start. And by putting in $500 for a month, you look to earn $1.50 after the first month. And come the second month, you can start another $500 fixed deposit, so by the end of second month, you'll have an interest of $3. And these can somewhat keep compounding itself. So ideally, you want to aim to save up to 6 months of expenses in these fixed deposits, which then can give you a cash flow in the event you lose your job. So once you have reached that 6 months of expenses, you can look into going for short-term stuff like T-bills for quick gains, and using some of those interests to compound back into the fixed deposit account. So if you're like me in your mid-30s, getting a house soon, going with the same route as above could be a good idea as well. But instead of leveraging for T-bills, we might want to lock our money into SSB instead for higher interest for a longer period of time. So the money in SSB then can act like a college fund if you're looking to start a family, and then with the additional money or income that we have, we can funnel some of those money back into T-bills to get some quick gains that can be put back into fixed deposits. But for me, I don't want to have too much money in T-bills because of liquidity. So since my money will be locked in for 6 months, and during that 6 months, a lot of things can happen which might not be in my favor, so I rather not leave that up to chance. So this brings us to the end of today's video. Subscribe if you haven't, like the video, we'll greatly appreciate it. It helps us a lot with the algorithm and stuff. And as always, stay safe, invest safe, and I'll see you in the next one.